Welcome to Wall Street Confidential, the show we give you the inside story as to what's really happening on Wall Street. I'm Greg Greenberg, here with Jim Cramer. Jim, the Dow's off slightly, but a lot of the components are acting real well off earnings.
You're seeing the beginning of the major run that I've been predicting for the Dow this year when I said it was going to be up 17%. You have way too many Dow stocks that are selling at 12 to 14 times earnings. That are generating way too much cash, that are beating the numbers substantially. We came into this earnings season with very low expectations, and one after another. I mean, Coca-Cola at 51. Let's talk about Coke at 51. The stock's been in 45, 50 for many years because it hasn't had an acceleration in earnings or revenue. Suddenly you get double-digit revenue growth and a real big acceleration in earnings. Why that stock would only be at 51 a year from now is kind of ridiculous. It could be at 60. Merck goes to 50, but Merck is still very cheap at 50. I have been saying that Merck could go to 60. That's probably too low. Now, before anyone thinks this is pie in the sky, let me go over the way the market really works. Historically, what has happened is that you get an initial burst when you have a big upside surprise. Then you mark time. And then as soon as earnings season is over, you see a gallop. So you're not going to see, other people are now saying, okay, well, Coke's really good. Let's wait till Pepsi next week. Merck's really good. Let's wait till all the drugs finish. And then you're going to get a reordering of the group. And it just so happens that the Dow components in each of these areas are much better than, United Technologies. Why isn't that going to go to 70? Well, it's going to. Only GE and IBM reported numbers that I think can't get their stocks going.
Well, GE just seems like it's 35 and bust. It just can't get out of the mid-30s.
I work for GE, but when I go over the components of GE, it wasn't that strong a quarter. That's not to say it's not a strong company, but it wasn't a strong quarter.
Now, IBM is weighing on the Dow today, but it's also a price-weighted index. It's a $95 stock, so it's going to hurt it a little bit more. One thing which is in the Wall Street Journal today, which was very interesting about what's been powering the Dow, is the whole supply and demand issue. You've had a whole lot of stock taken out in 2006.
29 out of 30 of the companies have been buyers of their stock. Now, we're beginning to see the buybacks really play a role. Go over the Eaton quarter. I really like Eaton. It got downgraded yesterday. I think that was a mistake. But you're seeing a real shrinkage of the float now. J.P. Morgan was saying, listen, we just thought our stock was way too cheap. They bought back in one quarter all that they bought back in 2006. And Jamie Dimon, a very good stock player. So, the companies themselves, the buybacks have been bountiful, but they haven't meant anything. Suddenly, they are really starting to mean something. In the meantime,
plus
the IPOs have
really,
the IPOs have slowed down. The deals have accelerated. My thesis at the beginning of the year was that we don't need stocks, that many of these companies shouldn't be stocks. They don't need financing. We're really seeing that play out.
It all comes back to supply and demand. All right, Jim Cramer, Greg Greenberg, please come back.